everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Dan Dicker, president of MercBloc LLC and a CNBC contributor. Dan, thanks for coming back on the show.
Thanks for having me, Mike. Yeah,
nice to have you back.
Yep.
You're the oil guy. We haven't had you on here in a while, so let me get your outlook now. What do you think is going on? We've seen oil pull back again below $90 WTI. Brent coming off, but is this just a pause before we go higher?
You know, actually, Mike, I think that there's some factors that are weighing into the oil market right now. They are, of course, economic. Some of them are fundamental, but most of them are economic. What we've seen, of course, is the Fed, with their QE infinity, release more money and, in fact, free up more money for people to chase risk assets. And usually that's meant that oil has gone with the stock market. And in this particular case, over the last week and a half, 2 weeks since QE Infinity was announced, what we haven't got is that blast in oil prices that most might have expected, along with the stock market, which has clearly shown a bid at every level. I mean, the stock market, 13,500 in the Dow, considering where we are, economically, bad growth numbers, manufacturing, all bad, unemployment, you name it. I mean, to see the stock market this high has been very much a function, as you know, of the Fed and money kind of chasing risk assets.
Right, but we also have growth in the economy. It's not very strong, but there's growth, and companies have found a way to, profit in the environment. We have a low labor cost that's definitely factoring in, and low inflation. So I think stocks there might be another fundamental going on.
Okay, but what we know is that what we know from history is that, at least in the last 4 or 5 years, there's been a very strong correlation between oil price and the stock market. So when you get the stock market rallying, you generally get that kind of chase in risk assets in the oil market as well, and that has not been happening the last 2 weeks. Now, let me give you two a little bit in the weeds ideas for why this hasn't been the case, and if I get too technical, then you'll stop me or you'll explain it better than I will. One of them has been the state of the crude curve. Now, the crude curve for the last, let's say, for the run-up in 07, and in fact the last two run-ups that we got in 09 and 10, we had what's known as a contango marketplace, where the prices that we saw in spot months were cheaper than prices that we saw in back months. Now, what that does is it drives physical players into, in fact, waiting to pump, creating shortages in certain places, and in fact not jumping into a marketplace to buy.
They're storing it, essentially.
They're storing it because it's what would be known to some degree as a carry trade. It's not exactly the same, but for the sake of explanation, it's a carry trade. If you're getting a certain margin further out in the future, you will put off the delivery of that and the pumping of that for as long as you can, because you're just getting a better margin as you go out further out in the curve. That's been the case that has driven, to a large degree, a lot of the strength in the correlated moves between asset classes, the stock market and the oil market, for the past 3 or 4 years. What we have right now is, in fact, a backwardated market. It's the first time we've had that in, about 5 years. So
what talking about WTI, and I think you're also talking about Brent. Brent has a pretty steep backwardation.
Both, right? Exactly. Both do. Brent is a little more intense. WTI is a little flatter. But the point is we haven't had this kind of shape of a crude curve for quite a while. And what that does is it puts an actually reverse cost of money factor into the market, where if you're a physical player, you're better off pumping today, even if you have to put it into storage. So what we find is that we have storage that is absolutely at the limits and busting out at the seams. For example, that's one of the major reasons why